Hey everybody, Smart Silver Stacker here. According to data released by the US Treasury last week, the world is continuing to dump US debt. The sell-off continues among foreign holders of US Treasuries, and this could mean some big problems for the Federal Reserve and also for the US dollar. We're beginning to see liquidity dry up in the world's largest debt market as foreign holders unload their US debt holdings, while simultaneously, the Federal Reserve is attempting to draw down their own balance sheet of US bonds through their ongoing program of quantitative tightening. All of this is setting the stage for a major debt crisis here in the US that could lead to a drastic reduction in the value of the US dollar and also much higher prices for gold, silver, food, oil, and just about any other tangible commodities that you can think of. And we're going to get into all of that in today's video, so let's get to it. Okay, so here is the data regarding major foreign holders of Treasury securities, and we can see that the total foreign holdings of US debt declined by more than $111 billion between September and October. And if we take a look here at the top 10 foreign holders of US debt, we can see that only 2 of them were net buyers of US Treasuries during that time period. And the 2 largest holders, Japan and China, they dumped $42 billion and $24 billion worth of US debt respectively. This brings Japan's holdings of US Treasuries to the lowest level since April of 2019. And to find a time when China was holding less US debt, you've got to go all the way back to June of 2010. Now, the motivations for reducing exposure to US debt are varied, but there are 2 big driving factors here. For some, the sale of treasuries is a bid to reduce inflation and shore up the value of the local currency, such as the yen in the case of Japan. But for actors like China, while defending the yuan may have something to do with the decision to unload US treasuries, a much bigger motivator is the overall move towards de-dollarization. In 2022, we have seen the dollar and Western financial institutions as a whole weaponized to a degree previously unheard of, and China is certainly taking heed of this. US-China relations are at a low point, and already the US has rolled out microchip sanctions in a bid to limit China's access to cutting-edge technology, and more recently, US lawmakers have introduced a bill to restrict Chinese tech giants Huawei's access to US banks. By dumping US treasuries onto the market, China is striking back by reducing liquidity in the US debt market and causing bond yields to move higher. Thus, China can make further debt finance spending by the US more costly and inflict some economic pain of their own, all the while reducing their own more than $900 billion in Treasury holdings, which they understand could become a significant liability in the event that this economic warfare heats up even further. Now, China may be selling US Treasuries, but one thing that they're loading up on is gold. And speaking of gold, today's video is brought to you by SD Bullion, my preferred gold and silver bullion dealer. If you're shopping for precious metals, SD Bullion is a great place to start. Check them out with the link down in the description. China recently announced the first official addition to its gold reserve since 2019, bringing up the total to 1,980 tons. However, this number probably significantly understates the actual level of precious metal reserves held by China, the world's largest producer and net importer of gold. 2022 has been a year of significant gold buying around the world. In fact, central banks haven't bought so much gold since 1967. And you can see from this chart that central bank gold reserves have now risen to the highest level since the 1970s. And again, the factors driving these central banks into gold are varied, but certainly one big motivator is the declining perception of the dollar as a safe store of value, particularly among nations that may be at odds politically with the West. Also of note in regards to gold is that despite the fact that the tonnage being held by central banks has risen to the 1970s levels, the percentage of global central bank foreign reserves held in gold has not risen nearly as much. Now, how does that square? Well, there's a lot more fiat currency floating around now and making up reserves than there was back then, and the supply of gold has grown much more slowly. So, in order for this percentage of holdings to rise to its previous levels, banks either need to buy a lot more gold or the price of gold needs to rise substantially. Personally, I suspect it will be a bit of both. One thing's for sure though, this shift away from US dollar denominated debt and towards the money of kings will be a very bullish factor for gold moving forward. Perhaps the biggest threat posed by this sell-off of US debt around the world is the declining liquidity in the Treasury market. Even Janet Yellen expressed concern about this back in October, and right now, not only are some of the largest foreign holders looking to sell their US bonds, but the Fed itself is engaged in a program of quantitative tightening to the tune of selling $95 billion worth of treasuries from its balance sheet onto the market every month. So, who's supposed to buy all of these old bonds? Well, someone will buy the debt, but the more important question is at what price? Too much selling and this decline in liquidity that we are witnessing could trigger a major spike in bond yields. And that's a big problem when the US has $31.4 trillion in debt. Rates go too high, and suddenly debt service could become the biggest item in the national budget. And that's an unsustainable situation with some pretty dire consequences. So far, a lot of attention has been paid to the Fed's program of rate hikes, but this balance sheet reduction program, aka quantitative tightening or QT, may actually be the more important element to focus on in the Fed's fight against inflation. Because if we do witness a debt crisis and a spike up in rates similar to what happened in the UK gilts market earlier this year, you can kiss quantitative tightening goodbye. The Fed will be forced to step in, not only canceling their bond sales, but possibly even being forced to intervene with emergency quantitative easing, or QE, aka bond buying, further expanding their balance sheet and buying up bonds to drive yields lower. Now, this is perfect for a US federal government that seems hell-bent on massive deficit spending and money creation, but it's not so good for the value of the US dollar, because the fact is that if the Fed resumes QE, or debt monetization as you might more accurately refer to it, they might as well dispense with all pretense of fighting inflation. And if this does come to pass, well, just expect the price of gold, silver, and anything else priced in US dollars to soar sky high. So this global dumping of US dollar denominated debt, it threatens to put some significant pressure on the US dollar. And as tensions continue to heat up around the world in 2023, it seems pretty likely that foreign nations' willingness to lend to the United States may continue to decline as a whole. This development will make it more costly to continue to finance the massive levels of deficit spending that are ongoing in Washington. And in a worst-case scenario of spiking Treasury yields, Fed intervention seems all but inevitable. So it's not financial advice, but if you ask me, central banks around the world know what they're doing when it comes to protecting their own assets, and now seems like a pretty good time to be shoring up our own personal reserves of hard, tangible assets like physical gold and silver. So that is what I am doing. What do you think come of this US debt sell-off around the world? What are you doing to get prepared? Leave me a comment down below to let me know what you think. Thanks for watching, everyone. Stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker, out.